Tonight, two simple ways to own the market and what actually differs in practice. An index mutual fund and an ETF can track the very same index. What changes is the wrapper. Structure first. An index mutual fund prices one per day and its NAV, the value of the underlying holdings after the market closes. You place an order during the day. It executes at that end of the day price. An ETF trades all day on the exchange like a share. Its price moves with supply and demand and will usually sit very close to the fund's NAV. Why is the ETF price close to NAV? Because of creation or redemption. Specialist traders can swap baskets of the underlying shares for ETF shares and back again. If an ETF drifts above NAV, they create shares and sell them. If it drifts below, they redeem, nudging price back toward NAV. How you buy and sell. With an index fund, you typically set up automatic monthly contributions and automatic dividend reinvestment. It's built for set and forget. With an ETF, you buy via your broker during market hours. You can use limit orders, see live prices, and trade in small bursts. Many platforms also offer fractional shares, but availability varies. Costs and frictions. Both wrappers can be very low fee, but check the expense ratio. There's also tracking difference, the real world gap between the fund's return and the index, driven by fees, sampling, cash drag, and trading. ETFs add market frictions. The bid-ask spread, the small gap between buy and sell quotes, and any broker commissions. In highly traded ETFs, the spread is tiny. In niche markets, it can be noticeable. Index funds avoid spreads because you transact an NAV, but some have minimum investments or platform fees. Premiums and discounts. Mutual funds never trade away from NAV. You always get the end of day value. ETFs can show small, temporary premiums or discounts, especially in fast markets or after hours. Creation or redemption usually keeps these tight. When each shines, choose an index mutual fund if you want automation. Salary take contributions, simple reinvestment, no intraday distraction. It's especially friendly for long-term regular saving. Choose an ETF if you value intraday liquidity, price control via limit orders, portability across brokers, or access to niche exposures that may not exist as mutual funds. ETFs also make it easy to move lumps of cash on your timetable. Taxes and wrappers. Tax treatment varies by country and account type. In some places, ETFs can be more tax efficient. In others, the difference is minimal. Always check your local rules and the account you are using. Takeaway. Think wrapper, not magic. If you crave automation and end-of-day simplicity, an index fund fits. If you want intraday control and wide market access, an ETF fits. Compare ongoing fees, spreads, and your own habits. Then pick one calm, low-cost path and stay the course. Sleep well.